in your note is a phrase out of another time and place, a stealth bear market. How stealthy are we in our bear market?
Well, it's less stealthy this year with obviously the NASDAQ 100, and Russell 2000 in that more traditional official bear market. But even in the case of the S&P, if you just look at the average member maximum drawdown from a 52-week high, the average across all 500 stocks is minus 25%.
Yeah.
So a lot of the weakness under the surface predated the invasion. It really traced back to the latter part of last year. And I don't think we get out of this mode anytime in the near future unless we get some miraculous, ceasefire and beneficial solution in Russia-Ukraine.
For the brave buying today or considering buying, do you stealthily buy the beaten up or do you buy the ones that didn't go down, the small set that stealthily missed the stealth bear market?
I don't know that I would necessarily try to trade around what's worked or what hasn't worked. I think where the leadership has been most consistent in the midst of all this sector volatility and even style volatility to some degree is factors. I spent a lot of time looking at Bloomberg's factors, and
that's what we like.
The value factors have been pretty consistent leadership factors, even in sectors like tech and consumer discretionary and communication services. So you can screen for the characteristic of value without limiting yourself to the sectors or areas that just happen to live in the value indexes. So I think quality value lowercase v is where I think investors want to focus, and avoiding areas like high volatility, weak balance sheets, non-profitability. I think that low quality trade is largely in the rearview mirror.
Liz Ann, we have seen a lot of outflows from equity funds, from riskier debt funds. But how concerned are you that as clients open up their statements and see deep red, they're going to withdraw more and that it will accelerate some of the losses?
I think it depends on what type of an investor you are. If you're an active investor, either you're doing it on your own or you employ active managers, there's been a more level playing field this year. There's more dispersion. There's ostensibly more ability for active to outperform passive. So I think it depends on where your money is. In the passive vehicles, I think if you were in passive vehicles that were more on the high risk end of the spectrum, tied to maybe areas like not just NASDAQ 100, but some of the sort of thematic segments of the market, you're probably in more pain than if you're indexed to some of the safer areas, particularly if you have a diversified portfolio and you've got buffers in other areas. So I don't think there's one simple answer to that.
But it goes exactly where you say the buffers. And part of the reason why I ask is because the buffers aren't working. And that 60-40 portfolio is seeing a lot of pain. You're seeing bonds and stocks drop together. Is there a new hedge, or are you saying to clients, look, actually now bonds are a better hedge because they're actually yielding more, and it is a time to rely on them in the traditional way?
Well, I know you guys have on my colleague, Kathy Jones, quite often. She's my counterpart on the fixed income side. And so I'm parroting her and her team's views a little bit, but felt that in the 2 to 2.25 range on the 10-year could be an opportunity to extend duration a little bit. We've had more of a short duration call, but I think you probably bump up around 2.25, that opportunity to extend duration. But you're right, we're in an environment where you have that change in correlation where you're getting hurt both on the equity side and the fixed income side. I think the broader message that might be sending is that we are in more of a secular inflationary backdrop environment, an environment where the U.S. and global economy is more subjected to supply shocks than demand shocks. And really for 30 years until about 2000, you had that negative correlation between bond yields and stock prices, which means positive correlation at the pure price level. So it unquestionably is a trickier environment, but if you take an active strategy in terms of things like duration, it can still add some diversification benefits in a mixed portfolio.